So as we start Objective 2, I really hope you've printed your notes. There's some tables that we're going to fill out, and I've put those in the notes for you. I've built those for you in the notes, so they will make your life a little bit easier as we go through and work these problems. Again, as always, I really want you to engage with the content, so pause the video, try to work things out on your own, and then restart the video so you can check your answer and listen to the explanation. But if not, you'll have to pause the video and kind of draw out the charts yourself. But if you have access to a printer, that will make your life easier. So we're going to apply these merchandise inventory costs under a perpetual inventory system. So GAP gives us four options under a perpetual inventory system. They said you can account for your inventory cost under any of these four methods: specific identification, FIFO, LIFO, or weighted average. Now, specific identification is really only going to be used in some special circumstances. Specific identification says that you know exactly how much this particular item cost as opposed to the item right next to it on the shelf. And so when you sell this particular item, you can move that item, that exact cost, out of inventory into cost of goods sold. Remember, what we're trying to do here is determine that amount of that journal entry. So really, we're only going to use this method for items that are really expensive, for items that have some unique identifying characteristics, and for items that we don't sell in really large quantity. So for example, Target and Walmart are not going to use specific identification method, okay? They're going to sell a box of Fruit Loops. They don't know that particular box of Fruit Loops was in the batch that came last week or the batch that came 2 weeks ago. But if I'm a car dealership, I know based on the VIN number exactly how much this particular vehicle cost versus the one that's next to it on the lot. So I'll use specific identification if I'm a car dealership or something like that, a jewelry store or something. Again, notice we said assumes. We don't know exactly which inventory items are being sold. We've got, let's say we're Smart Touch Learning, we're selling tablet computers like iPad or Surfaces or something like that. I have two that I had, and then I bought four more, so I've got six total. I've got all six out on the shelf. They're all identical to the consumer. The consumer doesn't know which ones are the older ones and which ones are the new ones. The consumer's just going to go pick up one and buy it. We're not keeping track of exactly which one because we're not using the specific identification method. If we use FIFO, we say, hey, I'm assuming they picked up one of the old ones. But if they picked up one of the new ones, no big deal. The difference is going to be immaterial in the end, okay? So under FIFO, cost of goods sold is based on the oldest items, and we're assuming that the items still in ending inventory at the end of the period are the newest items. Okay, so let's walk through an example. That's kind of the best way to go through this. So we have some data here. These are printed in your notes, and then you'll notice that big chart in your notes. We're going to go through and fill out that chart together. So it's important that you're filling it out with me because there's a specific way to do it, and you'll have these charts on your test, you'll have these charts in your homework, and I want you to know exactly how to do it. So we're looking at our tablet computer sales in the month of August. We started off on August 1, and we had two tablet computers on hand left over from July, and those had a unit cost of $350. So in our chart here, notice it's broken into three sections: purchases, cost of goods sold, and then the last section is inventory on hand. So I'm going to go ahead and put my date of August 1 in the date column, and then in the inventory on hand, I had 2 units at $350, so that's a total cost of $700. So if I were to look in my inventory T account right now, it would have a balance of $700 in it. So I'm going to just up here in the corner draw that inventory T account, and it's going to have a debit balance of 700, which represents 2 tablet computers. So then we're told that we bought 4 more tablet computers and we paid $360 for those. So prices are increasing. So in the purchases column, I'm going to show that I bought 4 units at $360. So 4 times 360 is $1440. Now, what I can't show you on this slide is the journal entry, but what I want you to be doing is practicing the journal entry on the side of your notes, and then we'll check those together on the next slide. So when I bought 4 units, I would debit inventory and credit either cash or accounts payable, depending on how I paid for those, for $1440. So I'm going to come up here to my inventory account and I'm going to debit inventory for $1440. So now I have on hand 6 units total, but be very careful when you're filling out the inventory on hand column. Don't just plug a big 6 in. We need to keep track of exactly how many units we have at each price point. So those 6 units are made up of the 2 old ones at $350 plus the 4 new ones at $360 for a total of $2140, which is what my inventory T account totals here. So it's important that you've lined those out, 2 at $350, 4 at $360, and you keep them in order, oldest to newest. Okay? Because the next thing we're told is that we sold some units, right? So we sold 4 units. Now, under FIFO, we are assuming that we sold the oldest units first. So that means we're assuming that we sold the 2 old units at $350 plus 2 of the new units at $360. So we're assuming that our cost of goods sold is the 2 times $350 plus the 2 at $360 for a total of $1420. Okay. Now, again, we don't know that we actually sold the 2 old ones plus 2 of the new ones. Maybe we sold all 4 of the new ones. Maybe we sold 1 old one and 3 new ones. We don't know exactly, but we're assuming. So, doing your journal entries, now that we've sold these, remember we're going to do every time we sell something, we have to do 2 journal entries. We're assuming we sold the tablet computers for $500 like we did in Chapter 5. So we'll debit cash or accounts receivable for $2,000, 4 tablets at $500 apiece, credit sales revenue for $2,000. Then we're going to do a second entry to debit cost of goods sold, credit inventory for $1420 now. So I have a credit to inventory up here of $1420. So now when I look at my inventory on hand, I'm assuming that the 2 units I have left on hand are 2 of the new ones at $360. So my balance in inventory is $720. So now I purchased 12 units at $380. Prices are continuing to rise. So I did my journal entry on the side to debit inventory, credit cash or accounts payable for $45.60. I'm going to debit my inventory account up here for $45.60. And so now when I look at my inventory on hand, I have 14 units in total. I have those 2 of the $360 plus the 12 new ones that cost $380 for a total of $52.80. And now lastly, I am told that I sold 10. So under FIFO, I'm assuming that I sold the 2 old ones at $360 plus 8 of the new ones at $380. So I'm going to do 2 journal entries again, 1 to debit cash or accounts receivable, 1 to credit sales revenue for 10 times 500 or 5,000. And then I'm going to do a second entry to debit cost of goods sold, credit inventory for $37.60. Now, since I had 14 units and I sold 10, I should have 4 units left, and because I'm assuming that I sold the old ones first, I'm assuming that the units I still have on hand are 4 of the new ones at 380. So my balance in inventory right now is 1520, and I'm assuming it's made up of 4 of the newest units that I bought. So notice the total columns here, or the total row here. So in total, I purchased 16 units and I paid a total of $6,000. I sold 14 units, and those 14 units under FIFO have a cost of goods sold of $51.80. And at the end of the month, I had 4 units still on hand, and those 4 units had a total value or cost of $15.20. So now here's those journal entries that we just talked through, that we just did under FIFO, and hopefully you've got those written down and in your notes and you've checked yourself and they're all correct. So now let's look at another method. The next method we're going to look at is called LIFO. LIFO stands for last in, first out. It's the exact opposite of FIFO. LIFO is assuming that I'm selling the newest stuff first. So I like to think of LIFO and FIFO like this. Let's say you went to the grocery store and you're going to buy milk. When you go to the milk cooler, what milk is pushed all the way up to the front? It's the oldest milk, right? The milk that is expiring the soonest. That's FIFO. They want you to buy the oldest milk first. Now, what do? I don't know about you, but I like to reach all the way into the back of the cooler as far as I can possibly get, because I want to buy the newest milk. I want to buy LIFO. I want to buy the newest things. So if we are a company that chooses LIFO, we're assuming that we're selling the newest stuff first. Now, most goods really do flow FIFO for the most part. We really do sell the oldest stuff first, except for 2 major industries. Anything that's perishable, we tend to sell the newest stuff first. If you're at the grocery store again and you're buying produce, you don't want the old apples, you want the new apples, right? The other thing that tends to flow LIFO is technology. When new technology comes out, typically that sells first, not the old stuff. Now, GAAP allows us to use LIFO, FIFO, specific identification if it's appropriate, and even weighted average, which we'll get to in a minute. IFRS, remember International Financial Reporting Standards, they don't allow LIFO. It's not allowed under IFRS. So a lot of companies that may have used to use LIFO have switched, because if you're a multinational company and you're doing business in multiple countries, then you're having to follow both US GAAP and IFRS. You don't want to keep up with 2 different inventory records. So LIFO isn't near as popular anymore as it used to be. But let's walk through an example anyway. So this is the same data that we had under FIFO. We're just going to now look at it under LIFO. So again, you've got your chart. We're going to fill that in. I'm going to encourage you to stop and try to do it on your own. Think through it and then pause, restart the video and listen to it. Don't forget to do your journal entries also. So we started off on August 1st with 2 units at $350 for a total of $700. So our inventory T account has a balance of $700 in it. Then we purchased 4 more units at $360. So we did our journal entry to debit inventory, credit accounts payable for $1440. We'll look at our inventory on hand. We have 6 units, 2 of the old ones at $350, 4 of the new ones at $360. Notice so far everything's exactly the same as it was under FIFO. Nothing's changed yet. But now, in the next entry, when we're told that we sold 4 units, under LIFO, we're assuming we sold the 4 newest units. So our cost of goods sold is 4 units of the $360. And so what's left on hand is still those two old 350 units. So we're assuming that when the customers went and picked up the 4 tablet computers, they grabbed all 4 of the new ones and they left the 2 old ones. So now we bought 12 units at 380. Same entry as before. Now we still have 14 units on hand, but notice those 14 units are the 2 oldest ones, the 2 original at 350, plus the 12 new ones at 380. Now in the next one, when we sell the 10 units under LIFO, remember we're assuming we sold the oldest ones first. So we're assuming that all 10 were that 380 price level. So we still have 4 units left on hand, but we're now assuming that those 4 units are 2 of those original at 350 plus 2 of the new ones at 380. So if you notice, we still bought 16 units. We still paid $6,000. The purchases column didn't change at all between FIFO and LIFO. We still sold 14 units, but now notice cost of goods sold is $52.40. If you look back under FIFO, it was $51.80. So cost of goods sold is higher under LIFO if prices are rising. If prices are rising, then we are assuming we're selling the newest goods, which are the most expensive. So cost of goods sold is always highest under LIFO if prices are rising. Notice ending inventory is still 4 units, but in this case, those 4 units have a value of $14.60. Under FIFO, they had a value of $15.20. So under FIFO, we're assuming that we sold the old stuff and the new stuff is in ending inventory. So we sold the cheap stuff. We had low cost of goods sold under FIFO. We're assuming the new expensive stuff is what's still in inventory, so we have high inventory under FIFO. LIFO is the opposite. So LIFO assumes the old stuff is still in the inventory and the new stuff is what I sold. So LIFO gives me high cost of goods sold and low inventory. Now, under the journal entries, hopefully you did those. Notice the only numbers that are different are the 2 cost of goods sold numbers. Otherwise, everything is exactly the same under FIFO and LIFO. Now, the last method we're going to look at is a method called weighted average. And weighted average says it's kind of a middle of the road between FIFO and LIFO. It says I'm going to calculate the weighted average of the goods, and that's the amount that I'm going to use when I sell something. So to calculate the weighted average cost per unit, it's the cost of goods available for sale. So this is the total dollar amount of goods available for sale divided by the number of units available for sale. That gives me a weighted average. Now, a rule of thumb that you want to write down in your notes is that you must calculate a new weighted average cost per unit every time you make a purchase. Every time you make a purchase, you must calculate a new weighted average cost per unit. So let's walk through an example using the exact same data that we did under FIFO and LIFO. So here we started out with our 2 units at $350 for a total cost of $700. Everything looks good so far. Now we've bought 4 units at $360. So we have a total of $1440. Notice now though, our inventory on hand is different. So here I have a total of 6 units, the 2 old ones plus the 4 new ones. And my total cost is $2140. That's the $700 from the 2 old units plus the $1440 from the new units. So to calculate my weighted average unit cost, I'm going to take my total cost of $2140, divide it by the units on hand of 6, and I get a weighted average unit cost of $356.67. So now when I sell 4 units, I'm going to use the weighted average unit cost as my cost per unit. So 4 times the 356.67 is how I get my cost of goods sold of 1427. If I had 6 units and I sold 4, then I have 2 left on hand. 2 times 356.67 is approximately 713. There's a little bit of rounding difference, I know. So now I buy 12 units at 380 for 45.60. I've made a purchase, so I have to calculate a new weighted average unit cost. So again, my numerator, my goods available for sale, is the 713 from inventory before plus my purchase of 45.60 gives me 52.73. And then my denominator is my total units on hand, which is 14, 2 plus 12. So I get a new weighted average unit cost of 376.64. So now when I sell the 10 units, I'm going to multiply that by the 376.64 to get my cost of goods sold number. And I still have 4 units left on hand. I'm assuming those have a weighted average unit cost of the same 376.64 to give me total inventory of 1507. So notice now I've still purchased 16 units, still have a total purchase price of 6,000. I've still sold 14 units, but my cost of goods sold, it's not as high as it was under LIFO. It's not as low as it was under FIFO. It falls in the middle, not exactly in the middle, but in the middle. Notice my inventory. Still have 4 units on hand, but they have a value of 1507. So again, not as high as it was under FIFO, but not as low as it was under LIFO. So this is really a kind of a middle of the road approach. So if we look at our journal entries, and hopefully you wrote those down, again, you'll notice the only thing that's different is these cost of goods sold numbers. So let's compare, we talked about this a little bit, but let's compare the effects on the financial statement of the different methods. We said that on the income statement, assuming prices are rising, cost of goods sold is highest under LIFO. High cost of goods sold is an expense, high cost of goods sold gives me low profit or low net income. So LIFO is going to give me highest expenses and lowest profit. FIFO is going to give me lowest expenses and highest profit. On the balance sheet, FIFO is going to give me the highest ending inventory, highest total assets. LIFO is going to give me lowest ending inventory, lowest total assets. Now, typically we want high profit and high assets. So FIFO is going to make me look the best, okay? If you have 2 identical companies, one uses FIFO, one uses LIFO, FIFO is going to look the best. It's going to show the most profit. It's going to show the most in assets. FIFO looks good to investors. So why in the world would anybody choose to do LIFO? Well, think about it for just a minute. What's the one advantage of having low profit? Did you get it? You pay less in taxes. So the one advantage of using low profit, of using LIFO, is that your net income is going to be lower, which means you're going to pay less in taxes. So GAAP has a rule that says, usually GAAP does not get into tax law, and we don't get into tax law very much in this class, only in some rare circumstances, but this is one of them. GAAP and tax law are 2 completely different. The IRS doesn't have anything to do with the FASB. The FASB doesn't have anything to do with the IRS. They're completely different. They don't even talk to each other, except in this one instance. And the FASB says if you're going to use LIFO for tax purposes, you have to use LIFO for GAAP purposes. You have to use LIFO on your financial statements. You're not going to use LIFO for taxes and FIFO for GAAP to make it look better but pay less money. So this is the one time that the FASB says, yeah, they coordinate with the tax law. So if we look at it here, notice that revenue was the same under all four methods. Cost of goods sold was highest under LIFO, and therefore we had lowest gross profit. Cost of goods sold was lowest under FIFO, therefore we had highest gross profit, and then again weighted average kind of fell in the middle a little bit. If we look on the balance sheet, again we'll notice our ending inventory was highest under FIFO, lowest under LIFO, and weighted average kind of fell in the middle.